Researcher John Bollinger. And one of the nicest things about Bollinger Bands and the indicator is that John Bollinger is still extremely active. Okay, so you can go at your convenience to www.bollingerbands.com and read and learn exactly from the master. You don't have to read and learn all the discretionary theory out there, because there's lots of gurus out there trying to teach you their own unique way of using Bollinger Bands. But you can go just directly to John Bollinger. But any way you look at it, the bands are a great tool that show you how price is moving, whether the market's overbought or oversold, or whether the prices are relatively high or low at their current price. Now, Bollinger Bands can be applied in all financial markets, including equities, Forex, commodities, and futures. Bollinger Bands can be used in most time frames, and this is the nicest thing that a lot of people don't realize. Many indicators do not work well in very short-term time frames. Bollinger Bands adjust quickly and works well from whether you're looking at a 5-minute, a 15-minute, or 25-minute, or 1-hour time frame, even if you're looking at a 1-day time frame. So Bollinger Bands works extremely well for the type of trading we're doing. Now, Bollinger Bands, and we're going to go over some live charts in a minute. Bollinger Bands are a technical analysis tool. Specifically, they are a type of trading band or envelope. Trading bands and envelopes serve the same purpose. They provide relative definition of high and low that can create vigorous trading approaches to the markets. So Bollinger Bands are used to measure the highness and the lowness of price relative to its current value. Bollinger Bands consists of 3 bands, or 3 lines, so to speak. It starts out with a center line, which is a moving average, and then it's got an upper band and a lower band set at 2 standard deviations. Okay, so it's the first thing I probably just said to you that you don't understand. So we start out with a 5-period standard moving average, we start out with a 20-period moving average, and then we have a 2 standard deviation above and 2 standard deviation below. So before we go on, let's take a look at a live chart. Okay, so we're currently looking at the euro US dollar. Okay, now, what we're looking at is this is a live chart, and this is my teaching chart. The purple line that is on the chart is a 20-period moving average of price. Nothing complicated. We all know what a moving average is. It gives us some general information, but we really can't make trades with a moving average. But for Bollinger Bands, it is the center of attention. Now, from this 20-period moving average, we calculate 2 standard deviations above and 2 standard deviations below. And we drop this on our chart. So what we have is an upper line. Actually, let me get my highlighter on here for you. We have an upper band and a lower band and a moving average band. So the upper band, or the moving average band, is known also as the basis band. I'm just going to make it a little bit thicker so it's more easy to see. And let's say for right now, for class, we're going to make it orange. So that's our moving average band. Above and below, we have our standard deviation, or our upper and our lower bands. Okay, we'll leave them a green, but I'm going to make them a little bit thicker also. And so now what we have is our Bollinger Bands on our chart. The light green area, the background area, is not important to us, nor is the overall shape of the overall bands. Now, sometimes they'll look like a snake. Sometimes they'll look like a space alien. It takes on all types of graphic depiction. But there isn't some strategy that says the snake strategy or the alien strategy. Now, the difference between the upper and the lower band and the moving average tells us also one thing. It's the volatility. The more volatile the markets, the wider the bands. The narrower the bands, the more contrite the market. But it's not telling you exactly how volatile it is. It's just telling you it's more volatile. So as you can see, when price is moving in a congested area, the bands contract. And this is known as the Bollinger Band width. This upper and this lower are the 2 times standard deviation. This is 2 standard deviations above and 2 standard deviations below. So in essence, they are the same width or the same distance from the moving average. Okay, now, I keep saying this word, standard deviation. Okay, and I know it's something you don't know, something I didn't know. And I have a degree in math, and I have a degree a master's degree in taxation and finance. I mean, I had heard standard deviation, but I didn't know what it was. Well, to be honest with you, you'll never ever have to calculate it. We're not going to calculate it because it's a complex mathematical area, complex mathematical computation. So interesting, in the real world, no statistician would ever calculate standard deviation by hand. But you have to understand what it is and where it comes from. Okay, and I'm going to try to simplify this so that we can kind of have some general understanding. So standard deviation is a measure of the dispersion of a set of data from its mean. It is calculated as the square root of variance by determining the variation between each data point relative to the mean. If the data points are farther from the mean, there's a higher deviation within that data set. Well, that told me, when the first 10 times I ever read this, and that was years ago, told me absolutely nothing. Okay, and I'm sure it told you virtually nothing right now unless you're a mathematician or statistician. So let's simplify it. We're going to use those same words. Standard deviation is the measure of the distance between a set of data. In this case, what's our set of data? It's the open, the high, the low, and the close from its, and another word for mean is moving average. So the farther or the more dispersed the price is from the moving average, the more it's deviated. So it's calculated by the square root. We know a square root, and we can't calculate that. Of the variance, by how far it is, determine the variation between each data point, between the open, the high, the low, and the close, and its average. If the data points are farther from the mean, there's a higher deviation within that data set. So if your moving average is at 1, and say your high is at 2.5, your close is at 2, your low was at 1.5, and your open was at 2, that's a pretty big dispersion from the average, which was at 1. Okay, the farther that dispersion is, the higher the deviation is within that data set. That's it. I'm not going to take you back there again. So in its simplest form, the mean is simply the average of all the data points in a given set. In investing, for example, you might want to know the mean closing price of the last 20 days. This can be obtained by adding the closing prices for each session, dividing by 20. It's a moving average. Because the markets are fickle at best, traders and analysts use moving averages that adjust daily, hourly, weekly to incorporate the most up to the recent data set. So standard deviation is calculated based on the mean or the average. The distance from each data point of the mean is squared, summed, and averaged to find the variance. Wow, that's a mouthful. Variance is derived by taking the mean of the data points, subtracting the mean of each data point individually, squaring each of these results, and then taking another measure of these squares. Standard deviation is simply the square root of the variance. Okay, we're done, I promise. You'll never have to calculate this. It's dropped on your chart automatically, but you need to understand what this upper and the lower line come from, because it's very important you understand that this upper line and lower line and the deviation is how far or how much deviation is there between the open, the high, the low, and the close from the moving average. And the more, if you're looking at a price that was relatively in the center and all of a sudden you get a high that's way far away from where it's been, that's an important piece of information. Well, if the high and the close are very far from that average, that's an important information. So that's what gives you that upper line or the reverse of the lower line. Now, if the high had jumped way, way high, the close have been very high, and the next time the high was higher and the close was higher, we also have volatility in the markets. So guess what's happening? That band is also getting wider. So Bollinger Bands consist of the moving average band is usually a base or the 20-period moving average, the upper band, which is by default 2 standard deviations, and the lower band, which is minus 2 standard deviations. And what do we have? We have a Bollinger Band on our chart. So let's go back to a live chart. So now we have our upper band, our lower band, and our moving average. Now, Bollinger Bands is one of the few indicators that's actually dropped directly over price action. Because as you know, most of the indicators are down below here, and they're placed on your chart below price action. Okay. One of the nicest things about moving averages, about Bollinger Bands, is they work directly with price action, so you're not being removed. See, when you put on an indicator like MACD, which is one of my other favorite indicators, it's down here. You're not really paying much attention to the price chart, and you can get lost in MACD and separate from the price. Here with Bollinger Bands, we are working directly with price, and price is ultimately the determination or the determining factor of what is happening in the markets. Now, even though moving averages are very simplistic and aren't so reliable as far as giving us any information by themselves, as part of the Bollinger Band, they serve a crucial purpose. When price is remaining near the upper band and stays above the moving average, it's telling us that that current trend, that uptrend, is intact. When price is trading below the moving average and following the lower band, it's telling us that that downtrend is intact. When price breaks through the moving average in the opposite direction, it's telling us that current trend is ending. Now, it's the relationship between price and the upper or the lower band. Now, everything is mirrored in here, so we're going to keep talking about the upper band, but if price is in a downtrend, we would be talking about the lower band. So as you can see, as price is moving up, there's a relationship to this band. And price is staying above the moving average and is constantly trying to push up and reach the upper band. When price gets rejected by that upper band, means it keeps trying to push up to it, but can't reach it. See how each time here it pushed up and reached it, eased back down, pushed up, eased back down, pushed up. Sometimes it rides the band, stays right on it. In this case here, price was able to touch the upper band there, but that's only an extreme high. At this point here, here, and here, it's being rejected. It can't even make this upper band. Sometimes price, you can see price pushing up and trying to get there and can't get there. But it's no longer able to reach that band. Now, at this point, it stayed above the moving average. So it's telling us that the uptrend is losing its momentum, but it hasn't petered out yet. And see here, it stayed above, and then it finally peaked up here. And then it gapped all the way down to here, broke the moving average, and did everything. Rode the bottom band, came back up. See, it stayed below. Okay, stayed below. Once again, now it moves into congestion. Okay. There's nothing to ride. There's no band. There's no nothing. But when we had a nice uptrend that you were looking to get a trade, okay, and if you need to get out of that trade when you get the rejection or the break of the moving average, and you can see how integral and important the moving average is to price and how price shifts on the Bollinger Band. So Bollinger Bands become a fairly easy indicator to read. They're not very complicated. Now, they can be used for many different reasons. And they serve all types of purposes. But in general, they tell us the strength or the momentum or the direction of the current trend. They tell us that the trend is healthy. They tell us when that trend gets a cold, and they tell us when that trend is unhealthy. And if you think about that, we're moving up here and the trend is staying at that moving average, but then breaks below. Okay, I don't even know what happened with the euro right here. I should look it up because I don't know exactly what happened. But as you can see here, it got a cold, but it didn't get sick. Or it sneezed a bit and didn't get sick. Came back down, rode it, goes up here and then stays above it. And you can actually see the degrees, because just because it's rejected by the lower or the upper lower band doesn't mean it's going to reverse. But when you get the breakthrough of the trend line, of the moving average line, then you have a very important clue. Now, my horizontal lines on here were not put on for this class. The horizontal lines are my support and resistance lines. But support and resistance to me are crucial for any way you're trading. And we can see some clues. Just look what happened at this resistance level. Look what happened at this support level. Okay. Price has actually stayed for the last 2 days right between a major level of support and resistance. Now price broke below. Okay. And we can use this interpreting what we want to do. So let's go back to my PowerPoint. And let's talk a little bit about how we would start interpreting this. Now, Bollinger Bands gives us 3 completely sets pieces of information. It gives us pattern recognition, which is, I don't use it for Bollinger Bands. Most people trading, short-term trading or our type of trading, don't use it because it take a very long time. It's like trying to find a head and shoulders while you're trading, CFDs. It takes so long to develop that you don't pay any attention to it. But it does give us pattern recognition. It also gives us early reversal signals. Okay, when price is rejected by the upper or the lower band, it's actually a warning system. It's telling you, I got a cold. Will I get sick? And then it gives us trend analysis. It will detect trend continuations or trend conclusions. So let's real fast run through the pattern recognition. The most popular and most well-known pattern that we get with Bollinger Bands is called the W and the M. Okay. It's similar to not in this formation, but in how you would actually look at a head and shoulders. Because first you get a downtrend, and this is for the W formation. And it comes down and peaks down and hits the bottom, bounces off the bottom, comes up here, and cannot achieve that high it was at, and bounces off and comes down and forms a second bottom equidistant to the previous bottom. You would have no idea you have even a pattern forming at this point until you get what we call the end formation. That's the conclusion of this, and that. So when it hits the second bottom and starts to bounce off, it's telling you have the end formation, which is moving to the W. The end formation is just your early warning system. Now, here it bounces off and starts making the fourth part of the W. But until it breaks the moving average, it's not a clear W. When it breaks that moving average, it is giving you a clear buy signal to buy for that upward trend. It also gives you the exact opposite in a downtrend. But in that case, it's called an M because it makes two tops instead of two bottoms. Now, to be honest with you, I've never seen this develop in a live chart. It does, but I don't trade in that long of a period of time. And even if you're using a 15-minute chart, you still need lots of candles to form this whole thing. Now, Bollinger Bands also works extremely well with other indicators. And one of the perfect matches is with RSI. And together, they tell you a very, very good story. And Bollinger Bands works well with a combination of RSI, MACD, and Bollinger Bands. And I'm going to show you shortly how to combine them into a successful trading strategy. But remember, during trends, the moving average holds very accurately. And a break of that moving average is usually a meaningful signal that the sentiment has shifted. So when price has been rejected by the upper or the lower band, until it breaks that moving average, you don't have a meaningful signal. The moving average can be used as a trade exit signal where a trader does not close his existing positions unless the price has broken the moving average. By combining Bollinger Bands with the moving average, a trader can create a robust trading method. Now, everybody asks me, okay, you tell me all this, but the fact is, that's all nice to see it in history, because you're not going to see it getting rejected from the upper band or the lower band until it's actually already happened. And we can only trade moving forward. So the only thing I can tell you is you have to practice, because this downtrend here and this riding of the bands here and this break of the moving average doesn't have any help for you 4 hours later. But so you have to practice and get used to seeing all of these different types of actions and learn to trust them, so that when you see price being rejected by the upper band, the lower band, and then breaking that moving average, that you trust what's going to happen moving forward. And that's a very good word, trust and moving forward. But the only way you can do that is by practicing over and over and over again. But so you don't have to freak out. You don't have to calculate anything. It's dropped on your charts. And you simply can look at the bands and see what they're doing and practice them. Now, there's several strategies, like the one's called the Bollinger Band bounce. There's another one called the Bollinger Band squeeze. There's all types of variations. But I'm going to share with you two little presentations. One is going to show you exactly how to use the bands in a more precise manner and how to get it, use it for entry and exit points. And then we're going to take a look at combining Bollinger Bands with other indicators. Now, this strategy is also known as the Bollinger Band squeeze, because when price is getting squeezed in between the bands, okay, it's a pretty straightforward strategy. It's relatively simple to implement. What you're looking for is when price is getting squeezed in the bands, it's almost like trading a triangle. When its price is getting pushed in a triangle to the apex, when it's being pushed into a tight little narrow band, sooner or later price has to break. It's either going to break out upward or downward. Now, the fact is that we have to note that narrowing bands do not provide any directional clues. They simply infer that volatility is contracting, and charters should be prepared for a volatile expansion, which means a directional move. And you can then use your bands to set a stop loss to take profit and enter the market when it does break out of that band. So when it breaks out, starts moving towards the upper band is going to get wider, and price is going to start riding that upper band, be above the moving average. You could then trade it, take a long position in just the reverse of it falls. So that's the Bollinger Band squeeze. So even though the Bollinger Band squeeze is straightforward, charters should be at least combine this strategy with basic chart analysis to confirm signals. It should be confirmed by a jump in volume. For example, a break above resistance can be used to confirm a break above the upper band. Similarly, a break below support can be used to confirm the opposite. Unconfirmed band breaks are subject to failure. Now, I'm going to show you how to combine this with RSI and MACD into a nice little trading strategy, and how to use it to interpret which direction and how to trade, how to enter the market and how to exit the market. Now, also, I've put together two handouts for you. And the Bollinger Band handout, which is on your screen, which you can download, covers all of this so you don't have to remember everything we talked about.
Indicator 1, RSI. The Relative Strength Index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals, such as MACD crosses. Indicator 2, MACD. The moving average convergence divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of two exponential moving averages, which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving close together, and divergence simply means they are moving away from one another. When the shorter-term moving average is above the longer-term moving average, this area of the indicator will show activity. When the shorter-term moving average is below the longer-term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market, and may use it as a signal to exit a trade. Indicator 3. Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of the time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4. Supertrend indicator. The supertrend indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5. Confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market, as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of the overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. We can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse and the market to retrace back up the opposite direction of our trade, and therefore is an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the supertrend indicator. We can see the market has hit the top of the Bollinger Band here, but we could also wait for the supertrend indicator to change red here before taking the short trade. So now we have the confluence of four indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations on the Bollinger Band, and we also have the supertrend turning back to red.